Welcome to the Defence Property Podcast, the podcast where we talk about all things property investing and real estate for Australian Defence Force personnel. Whether you're looking to build and scale a property portfolio or relocating across Australia, we've got the insights and tips for less stress and more success. Let's dive in.
And welcome back to another episode of the Defence Property Podcast. I'm pretty excited about today's episode. It's going to be a good one. We have Chris Tipper back from Ainslie Wealth as the Chief Economist. Chris, welcome.
Thanks, Kane. Great to be back. Great to have another catch up. I know we've got plenty we can discuss because we've had a little while between our chats on this.
Yeah. Definitely. So today we are talking a bit of I won't say controversial, but a bit of an interesting one, bit off topic from our normal, or a little bit, Bitcoin versus property.
Yeah, and it's going to be interesting because I'm going to have to temper myself a little bit. Normally I would temper myself a little bit, put it that way, when we're sitting down to talk to a property audience when I talk about Bitcoin, because I don't want to come off as a Bitcoin nut job, a Bitcoin maxi. I am a little bit, but I can see benefits of both. But it's going to be an interesting discussion, I think. Cool.
So before we kick off, I guess, why would people listen to you, Chris? Like, give us your, I guess, a high-level resume, from a personal interest in investing, your background from where you started and what you're doing and what led you to be Chief Economist of the Ainslie Group.
Well, I mean, why would anyone listen to me? So I used to be a high school teacher, so I'm used to people not listening to me when they should probably. But for me, the journey, it was from that high school background, teaching background, and being a business and economics teacher. We're always looking for stuff to do, and the practical thing to do is trading, investing. So for me, a lot of my background was playing around with this stuff and genuinely playing around with it. So whether it was stock trading, whether it was what ended up Forex trading, or trading commodities, all sorts of stuff. I do it myself because I wanted to learn how to do it, but I'd also do that with the kids in the classroom because it was high school kids and they were very interested in that. So bigger than the economist role, I think the background of actually having traded that stuff and tried so many different things over the years, getting to the point where I could retire from teaching and just live off my trading and investing skill, that's probably the resume that matters. And the Ainslie angle, that came about because I was in that situation, because I was going, I need to move between, I was moving between at the time crypto, Bitcoin, it was more XRP at the time, but moving between crypto, physical metals, the trading aspect of that, I'd always been interested in it, but also practicality for what I was trying to do and how I was running my finances and business. I just ended up, because I was involved in that stuff and very interested in the economics background and everything that I brought with me, that's how I ended up in that role. But really, the resume, I think, is an important one, that it's not so much about training, it's about real world. And I think that matters. It matters for our customers, having someone who understands metals because they actually do it. They're actually in there, they're actually trading it. They understand crypto because they do it. They've played with this stuff. They don't just have an opinion theoretically. They've made the money, lost the money, the soaring heights and the massive depths that come with learning the hard way. Life's lessons. But I guess, like with any asset class or pathway, career, business, you want to find someone that's done what you're wanting to do and someone that's walked the path you are. So hence we're a property podcast. I've been in property and investing in property for 20 years. It makes me sound really old. I don't feel that old. But and that's why I guess we run this and help people, navigate that first property purchase through to building a portfolio. And I imagine, gold and silver and Bitcoin or crypto is no different to that. It isn't. I mean, you and I personally have had sort of debates over the years about where the allocation should be. Just a few. And I mean, we've both moved on those debates, right? I've moved from hardline positions probably at extremes into some sort of middle. And a lot of that for me has been, talking about my journey into property, has been, no, I want the flexibility of liquid assets, right? Like, so when you talk Bitcoin in particular, it's very liquid. I can move in and out. It's very useful for that ability to trade and be able to move where the market is and do things we can talk about like shorting or protecting your position. You can't do that with property. But what's really interesting, and this was part of the journey where you sort of pushed me many years ago, when you have that property, there's still something, a safety mechanism that you feel at your core that doesn't exist when you don't have it. So it still feels like a backup to me, and I still have that sort of property sitting there as a core part of my portfolio that I can't get rid of because I go, well, there's value there beyond what money I can make from it. It's not about it. It's not a money thing.
Yeah. Before we get into, I guess, the in-depths and stuff, like a lot of our audience would be listening with interest on property. So some of them could have heard and be exploring, and some may even own Bitcoin. Some have never heard of that. Just give us, I guess, a simple explanation, being that there could be some seasoned Bitcoin crypto listeners, or there could be someone this is the first time they're hearing, about Bitcoin. Hopefully they've at least heard of it. But tell us, what exactly is it from? Just give us your high level, Soldier's 5, we would call it.
That's the hardest question you could possibly ask someone. Just explain this really complicated thing in like 5 words or less. But how I would look at it for this audience is all of that doesn't matter. Like the specifics of what it is and how it operates and blockchains and crypto and all this terminology doesn't matter. What matters is that Bitcoin is the best performing asset, has been the best performing asset year after year since its inception. Yeah. So that goes through big highs and big lows, but if you just average that out and look at where it is,
put your head in the sand,
put your head in the sand, buy and put your head in the sand, it's outperformed everything else. So that's what matters, because I could be completely wrong with all that technical, like of what it is and how it works and why it's
still be right on the performance.
And I'll still be right. And even if I'm wrong, and even if you think it's a terrible idea, like who are you spiting by not having at least a little bit? That's the argument that I make. Because the one key piece of information for everyone is the 21 million, right? So that's the maximum amount of Bitcoin that can ever exist. How that happens and why that happens is kind of irrelevant. But the point of there's a capped supply, a fixed supply. I mean, I deal in gold. There's not a capped supply or fixed supply of gold. We go, there's a limited amount, but we don't know what that actual max is, because you've got mining. I think it's a couple of % per year just in mining. Yeah. You've got all of these other avenues where you don't have certainty because you don't know how much actually exists in any one place or whatever. With Bitcoin, none of that. Absolute certainty. 21 million is the maximum that will ever exist, and we know and can prove where that is at any time. So
I'm just looking up an interesting stat at the moment, if I can find it. But I think there's it's not. I haven't got it. I was just looking at how many dwellings there are in Australia. I think it was in an episode we did a few weeks ago. But yeah, the thing is, like 21 million Bitcoin, there'll never be any more. Like it's an actual proper fixed supply. Yeah. Whereas real estate, we can turn one into two. We can build up. So that's additional supply. And supply is the enemy of growth. So when we're talking about Economics 101, like supply and demand determines price fluctuation, positive or negative, and stock to flow is essentially how much new supply is coming to the current stock level, and that's for
and there's nothing like it, right? Like that's the point here. And the arguments that you often get against it would be, well, we don't know, it's not proven, it hasn't been around for 5,000 years, but you can wait 5,000 years if you like to figure out if it's going to be there still. But the point is, when you've got the best performing asset, a new emerging asset that you can still be on the adoption curve of, because not everyone has it yet, that sort of angle, you have an opportunity there that everyone should at least have some. I say that, not financial advice, absolute financial advice. Everyone should at least have some, because if I'm completely wrong and you've only put a small amount in, you lost nothing. Like it's just a normal gamble. If I'm right, that can be a significant part of your investing portfolio in the future.
Sparked a very interesting thought. Like, I don't play the pokies at all. I just don't understand why, they're just not something that but people would put $20, $50, $100 a week to the pokies. Like, imagine if you had dollar cost averaged that amount into Bitcoin over the years of its existence.
Well, and I know why people don't, because they go, well, no, it's going to zero. Well, guess what? Your pokies money's going to zero.
Well, 100%. Like, there's, when it's the finite supply amount of 21 million and it's never going to be any lower with an adoption curve that's occurring, a track record of 15 years, not 5,000, but I'm sort of making an argument here for the person sitting across from me when I'm on the property side. But
well, and that argument of going to zero, right? Like, this is one where I'll push back a little bit on the property bit, because people say, but what if it goes to zero? Well, for starters, it's not going to zero, because when it goes to a cent, I'll probably buy up all the remaining, right? Yeah. So there's at least one person in the world who's going to keep buying. Yeah. That argument doesn't make sense, because obviously it's reached a level of adoption where it's not going to zero. It might go down, it's not going to zero. The problem I have with the property argument, where people go, well, no, you want that because that's the guarantee, right? Like, that's the certainty that you have. Well, I'm not so sure about that these days, that there is that certainty, because yes, property will still exist. But at the end of the day, what happens if you don't pay your taxes, like your property taxes? What happens if you don't pay whatever
your rates notice,
whatever government arbitrary thing is put on top of it? Well, you might find very quickly that you don't really own that asset quite as convincingly as you thought you did. Yeah. So as an asset, does it have some of those qualities that make it an absolute sure thing? I'm not so certain about that. I don't think it is an absolute sure thing. There's a base level, like that's the same. I'm not saying property can go to zero for the same reasons. It's not going to zero because everyone needs a house. Everyone needs.
There'll always be an underlying element of demand.
But can the property cycle exist in Australia? And it wouldn't look like it if you've been alive for, all of our lifetimes. It's been one direction up and to the right. But can there be fluctuating cycles that increasingly come about due to economic factors, where governments just have to squeeze the money out of the easiest place to squeeze it? Is that the property market? Is that investors?
Well, we're seeing that now, aren't we? Properties, yet to be confirmed in the May budget, but they're looking at reducing the capital gains tax from 50 to 33 or potentially 25%. Property's the only asset that they're talking about doing that too. So, I think property, the household net worth in Australia is predominantly all in property, and the property wealth in Australia is 3 times super.
And that's the argument we've always made as bullion dealers, right? Because people like to bring up this, what if they confiscate the gold? And I go, they're not going to confiscate the gold. I'll tell you why. Because in Australia, we have a superannuation market, a superannuation slush fund, which would be where you would confiscate first. You would always go to that first because they've got control over it, right? Like the funds, and they could just implement laws that...
Well, tax is just confiscation, isn't it?
Well, it is, but
50% to 33, reducing the tax exemption, that's just confiscation of wealth.
It absolutely is, right? And that's
not sugarcoat.
That's right. It's still one way or another an easy target. I always say the superannuation one, but property one, as we're finding out at the moment, has probably turned out to be even easier.
Yeah,
because it's easy to change that rule. How do you capture everyone if you reduce that capital gains tax exemption? It does automatically capture everyone. Like, why would you go after little finicky things on the edge, like gold investors as an example, or crypto investors? You're not going to go for them. You're going to go for where you can raise a lot of money very quickly when you're in a difficult situation.
Well, stamp duty on purchase property is one of the largest state revenue raisers the government's got per state. So I feel like I'm arguing on the wrong side of the the equation here. But We've had many conversations over many lunches and stuff, and we're only talking about the capital gains tax the other day in a chat group. But I still feel like I love my property and always will and always be my first. But you build your wealth, like it does give so many good, like when you can apply multiple asset classes to one portfolio, property that build from the bottom up, like by having, if you have $2 million in Bitcoin, you could have $4 million a few weeks later and $1 million a few weeks after that, due to the volatility. And we can make an argument, and I know you would, the volatility is a feature, not a bug.
Yeah.
But it's still volatile and it's still volatility, and it's up to the individual person to manage that volatility, and that's where a skill needs to be applied or knowledge needs to be applied. And property's no different. You can get property wrong, but it's a lot slower and more lethargic and drawn out.
But is that safety? That's the debate that I would have. People feel it's safe because it's not as volatile.
Well, my point that I'm making is if you have your property portfolio and you've got a lot of equity, you've built it over time, you can draw out and you can get your exposure to Bitcoin or do whatever you want. But if you do and you pull out $100, $200, $1 million and you buy Bitcoin and you've got your property, at least if your Bitcoin goes highly volatile up or down, your net worth or net asset is still your property portfolio. So if you have $2 million of a property portfolio, you buy some Bitcoin, you've now got a blended portfolio, but at least if your Bitcoin, and I don't believe it will go to zero, and if it does, at least we know Chris here is going to buy them all at 1 cent or so, but I've probably met a lot of people that have said that. So
some people probably buy it at 2 cents.
Yeah,
They're
that's
try
right.
And
there's a couple of 3 cents. And, but the point is that if you've got your $2 million of real estate, your portfolio is theoretically not going to go much lower than $2 million because property it does go down and it has its cycle and stuff, but it's not highly volatile. So it's a lot more stable asset class, and it's a lot more, because of the stability, it's a lot more leverageable. So, and with that leverage, we can control $1 million asset with $100,000 of exposure. And I guess when we have a property portfolio and we manage it appropriately, we pick our markets and we've got enough equity, we can manage it like a business where we can just go to the bank and I've got $0 in the bank, I've got equity, I say I want another property, and obviously normal lending criteria applies. We can get another property, another $700 million property, and just manage the cash flow and the balance sheet being our purchase of the property and make sure we've got our equity portion of the portfolio. And we don't actually need to contribute anything to it. There's never going to be that world exist in the Bitcoin space.
Maybe. This is where the derivatives and where there's so much happening in that space. I mean, I spent a bit of time recently with the guys at Block Earner, and they have partnered with, I think it was Century 21 or one of the providers in Australia, that they were lending. People were being able to borrow against their Bitcoin to buy residential property.
Yep.
And you can imagine this is the benefit of having a flexible asset. I don't necessarily disagree with what you're saying there about you building the property portfolio and then you can borrow against it, because obviously the entire system is set up to borrow against property. That one, I'm never going to win that argument.
No, and that's why it underpins.
But it could be the other way around. It could be upside down in the best approach to take, particularly for young people.
Yeah.
Because I look at people who go, well, how do I save up enough to get into the property market? And the cheat for that could be to go the other way and accumulate some Bitcoin, accumulate something that's actually growing faster than property would ever grow, and then using that as their leverage point to enter the property market through things like borrowing against that Bitcoin, or you could just sell it. Is the other point, and I've certainly known people who've done that, but it depends who you are. So I think for young people or people who are struggling to get into that market, maybe putting aside every dollar to save up for a deposit in a rapidly in a rapidly growing or inflating market is very difficult to get ahead. Whereas there's an opportunity there to use some of those same economic forces to your advantage, because they're the same forces that are pushing the price of Bitcoin up, to be saving in Bitcoin and then switching or borrowing against that when the time comes. Because obviously, for the reason I said right at the start, property's not, there's more to it than just the financial asset.
I think this is an appropriate time to put in a disclaimer, not a full blown, but I don't disagree with what you're saying, and I think as like with my knowledge across multiple asset classes, times are changing, and you know, but to do that strategy, you really have to have a fairly good understanding of what you're trying to achieve and what you're gonna when you're gonna buy, when you're gonna exit. Like if you're trying to, it's highly speculative if your time frame is say less than 12 months.
Yes.
You know, if your time frame was 5 years, I would be a strong advocate for that.
And,
a pretty
and
sensible
I have
plan.
this.
But I've got knowledge and understanding across.
Exactly, and I have that exact debate with people all the time.
Yeah.
Who I had one just a couple of weeks ago. A young guy, probably around 2021, saying, "Well, I'm saving up. I want to buy this property. Should I put in Bitcoin?" And he needs the money in 3 months.
Cool.
And I'm going, that is not sound financial decision, because it doesn't matter how confident I am in the long-term trajectory of Bitcoin, I don't know where it's going to be in 3 months.
No.
So that's absolutely to your point.
Yeah.
It matters. The time frame matters.
Yeah. And this is where having knowledge to apply to, you know, one, buying a property and what you need to do to be able to do that, but also knowledge across the Bitcoin asset class and implications of if I put savings in it and then cash it out 3, 6, 12, 4 years later, what tax implication is there as well before? Because if you triple your money in a 3-year window with your Bitcoin and then go spend it all on a deposit for a property, and you
absolutely
don't park your tax aside, so you need advice from your, you know,
well, you need to
accountant.
figure, and that's where
need to be in depth in the numbers.
If you were talking over a 3-year or 5-year time frame, I would be looking at it like these products are starting to emerge that will let you borrow against your Bitcoin.
And that's the other argument that.
So then there's huge tax benefits to that, right?
Yeah.
Because then you're not selling it.
Yeah.
You're just borrowing against it, and that is a big driver of these businesses. The people I've spoken to who are doing that strategy is really around tax, because they're going, well, it's a more optimal way to not just sell everything, get that big tax hit, to then go buy another asset with it, where they can use one to leverage off the other. And then ultimately, isn't that an interesting flywheel? If you've got some Bitcoin you've accumulated that you're borrowing against to establish your deposit for your home loan, then you're paying down the equity, building the equity in your property that you're then using to borrow back to top up. So there's a friend of mine refers to as optionality, right? Like ultimately, the problem with any of these is when you just go one path, you don't have optionality. That's not to say we are absolutely against diversification, which is a very unusual thing to say for a lot of people. But we don't believe that just spreading all your risk over different things that actually have the same risk is a good idea. And what I mean by that is people go to the share market and they go, well, I own the index. I own a bit of everything. Well, they all go up and they all go down together. You don't have, that's not diversified. Diversification has got to be different things that actually are uncorrelated.
100% agree. And I think we've heard, is it the Michael Saylor version of diversification, that it's selling the winner to buy the loser? You know, or Warren Buffett would say, you know, just selling the winner to buy the loser, I guess, that it's not necessarily putting you in a better position, you know.
No, and a big part for me, and we've discussed it before, you have to be focused on these assets. Like just saying, well, I'm buying property. What does I'm buying property even mean, right? Like, am I buying somewhere in the back of nowhere that has no growth prospects? Am I buying an inner city apartment that also has no growth prospects? It matters. You got to know your stuff, and you don't know your stuff by just deciding that you're going to do it one day. There's research. There's so much to learn. And
I've personally held property in my portfolio that 15 years later, it's worth exactly what I paid.
Yeah.
And I've owned property in my portfolio that's gone from 675,000 to 1.5 in 4 years.
And that one that stayed the exact same price, that's gone down. Like, that's the thing
Well,
people need
you've
to
lost,
understand.
yeah.
You've lost.
Yeah,
Like,
'cause
that's not
inflation
even,
has
oh,
occurred
well, I
over that
didn't
period of
lose on
time.
that. Well, it's not even just the inflation. What did you pay in property taxes? What did you pay in
Yeah.
rates and every other maintenance and every other thing along
But it
that
wasn't
journey?
property's fault. It was my fault.
That's
Because
that's
I
it.
brought in the wrong
You
market.
have to
In that
you have to
exact
know.
same period of time, year to year, there was other markets within Australia that well and truly outperformed the long-term average of property as well. You know, so in a different market, I could have doubled in that 15 years, but I sat flat because I was in the wrong market. So it wasn't the property. It's like, I guess, shares. You can buy shares and some can go to zero, and you can buy some and they'll double in the same period. But it's not shares' fault. It's the company that you chose. You know, or the
And I just don't like, and lots of people disagree with me. Financial planners will definitely disagree with me. But I don't like that approach because I'm going, why buy lots of things that I know nothing about on the hope that one of them does really well?
That was Buffett's. It's for people that don't know what the diversification's for people that don't know what they're doing.
And you just,
You know,
all you're doing is buying all the lottery tickets, hoping that one of them wins.
Yeah, if you buy
but
all
you're
of
still
them and don't let
not
anyone
getting
else.
ahead.
Yeah.
That's not, in my mind, that's not the way to do it.
Spend
I would
$1 million
rather
on
have
all the lottery tickets and win $1 million.
That's it. And wouldn't you rather have one or two, and I don't think it can be more than one or two, to be honest, one or two investments that you really understand.
Yeah.
Or you might not really understand them, but you've at least put some effort in. Then I'm just going to, and super, don't get me started on super, how people do this, because they just go, oh, I just ticked the box, right? What's the box? They tick the box to say it's diversified, or they tick the box to say high risk, or they tick the box to say low risk, or they tick the box to say Australian shares or international shares or bonds, or they know nothing about any of these things.
Yeah,
but
see,
they
I've
tick
got
the box.
pretty strong opinions on super as well, because not everyone is an investor and not everyone wants to invest, but everyone is to an extent because they all have super.
Yes.
And it is your money that you're entitled to. And when the day comes you get access to it, you're going to bloody wish you did pay attention, because that is the day that you retire and you say, how much have I got in super? You're going to wish it was more, no matter how much it is. Whether you retire 5 million or 50,000 in super, you're going to wish you had more than you do when you retire.
Absolutely.
With a very small exclusion of people that have probably got more than they need, but it is that minute that most people want more. So the time to care and learn is now.
Well, often people decide they want to care and learn about that when they're 60.
Yeah, which is just too late. You don't have time.
You don't have that optionality, right? Like, you don't have that ability to adjust what you're doing based on what's the best option for you at the time. And is it? I mean, I have increasingly less time for that argument that, well, it just doesn't interest me.
Yeah.
It doesn't impact me or whatever. I'm just not, because
You decide your own level of involvement.
But those same people ultimately come back
Yeah.
down the track with, oh, I'm in this terrible situation. Why didn't anyone tell me? Or why didn't? That's not how it works.
Yeah. And I think when we start talking about, bringing property and Bitcoin and whatnot into a portfolio and stuff like that, when we're talking about the deposit and banks, and there'll be a lot of potential naysayers out there or keyboard warriors that will listen and comment on in socials, and we'll see it across Instagrams and TikToks and stuff. But the day will come where you won't need to, like Chris here, will not need to sell his Bitcoin. He can just borrow against it to go buy a real estate. Because we're seeing in America now, Morgan Stanley, I don't know that if they're in the top 3, 5, 10 banks in America, but they're one of the biggest players in the American banking system, have released their own. So not a Vanguard, not a different ETF provider. Morgan Stanley have created their own ETF so they can profit because the fees that they can charge. And that's less than a week old, I think.
Yeah.
And I think they average like 60 million on the first day. And people that
and
are
it's-
purchasing it. And
it's
if they're a
not-
bank,
Well, it's not even coming. It's here now. It's just not here for everyone now because it's a bit complicated.
yeah.
As I was saying before, there are players in Australia right now.
But that's only their first product.
That's it. It's
know.
all. It's that bit is clearly coming.
They'll say, okay, we want to sell more mortgages. Well, okay, we've got X, Y, Z million in Bitcoin held for all of our investors. Let's just let them borrow against that and then come over to us over this department and borrow and get a mortgage.
Well, it used to be. So this is an interesting angle to look at it too. When you think about gold, banking used to be backed by gold. So you used to be able to go and deposit your gold at the bank, because we're talking a long time ago. But that was your currency as it exists today was certificates for that gold.
Yeah.
So you would deposit that gold. You had basically a certificate, a paper certificate that said this is how much gold you had that you could trade to make it easier to solve that problem.
Yeah.
So these days, you want to try, because we've tried this before. We've tried, and we got very close, but they wouldn't do it, to work with the bank to allow people to borrow against the gold, because we'd say, well, the gold's in your custody.
Yeah. Yeah.
There's no risk to you. Like, it's actually riskier. When you think about it, it's actually riskier for a bank to have a house in their custody, because you can do all sorts of damage to your house.
Yeah.
And it's not in their physical custody.
That's right.
Like, it's a
They've
more
got
of a
security
theoretical
over the-
construct, this
They've got
whole
security
custody.
over the custody, but they don't actually have
the actual
custody of it.
physical. They had physical
Correct,
custody of the gold. They could go sell it. They could do whatever. But they wouldn't come at that, because that's not how that system is set up. But that's how it used to operate when you
And
go
you-
back far enough.
you can look
so to say that we're not going back that way with some of these assets that are very easy for them to do that with, if it's incentivized, which it is, because they can obviously do more.
And we evolve with time. Like, if we go back to 70s, 80s, you needed 20%. There was no first home guarantee. You know, there was no first home buyers grants. Like, these are all schemes that have come in through time, and then we went to 10%, and then there was 5%. Now there's even 2% with backing from the government and stuff. And then the day will come where you need 0% cash. You just have to put your little Bitcoin in with the bank. We'll tie it in with the mortgage documents, and you got one Bitcoin and a house. Your total debt and the total LVR will be based on the house value and the Bitcoin value. You know, these products will come as the banking system and the mortgages for the property have evolved over time from needing 20%. Like, it's a first home buyer specifically, very rare to have 20% these days. I think is fair.
Absolutely. I mean, anyone who's having to put up 20% is usually attached to non-traditional rails.
Yeah.
Like they don't have a standard job. They don't have whatever it is.
Yeah. And as the banking's evolved from those days of must have 20%, and then it was must have 10 and 5, and the day will come where people will, have security over other assets to provide their deposit, I guess, as a banking system to these products evolve.
And there's a little bit, which gets into the weeds a little bit on it, but a little bit of this is being driven by digitization of all assets as well. So Bitcoin is a purely digital crypto asset. That's fine. Like, it's its own thing.
Yeah.
But we've done it, right? Like, we digitize gold and silver. So you can buy digital gold and silver on a blockchain. You can swap between someone else completely independently. That's the world that's coming for property, for all of these things. So the big banks are all very well aware of that. They're trialling their own programs in this because they go, well, ultimately, the ledger, you think about how the ledger operates now through a titles office. Right? Like, effectively, this dated sort of ridiculous bit of paper with a stamp type of scenario. As that becomes digitized and people can switch ownership through tokenization of real-world assets, it makes a lot of sense, and that's obviously where things are going, not just because logically it makes sense, but also because there's a big push from governments all around the world to head that way, because it's more transparent, it's safer, there's many, many reasons to do that over the ye-old titles office.
Interesting. So I guess just take us through, we'll go back to level 0 to the person that's, I guess, first hearing about Bitcoin and learning about it. What are some avenues? Tell us about the Ainslie Group, the products that you have there for people to get exposure, and some sort of, initial tips and safeguards for people getting into this space.
Sure. So Australia's going through significant regulatory changes right now. Yep. So these laws have passed. Yep. Great thing.
Yep.
painful thing for people wanting to buy crypto because they run you through the ringer in terms of KYC, know your customer stuff.
Yep.
But I mean, certainly, if we were debating it with property, it's no different to property.
Or opening a bank account or anything, which is good, which means it's evolving. And,
it's part of that evolution.
And it's maturing as an asset class.
But the biggest challenge, I think, for customers or anyone coming in new is this idea that you can hold it yourself. You can absolutely do that, but that requires you to know what you're doing.
Yeah.
So really, and even the regulation is now moving on that to say we have to check that you actually know what you're doing before we send you your crypto, because there's lots of scams, lots of people that make silly mistakes that end up losing that asset.
And just to jump in, what people understand is Chris probably isn't talking so much you can't hold it yourself, like have it on an app on your phone. He's more talking about a cold storage, if you've heard the term,
so like a ledger.
It's on a ledger, on a wallet somewhere there. You have a seed phrase, and again, not trying to get into the weeds, but he's not referring to holding it on a regulated exchange in Australia on the app on your phone. He's talking about more of a cold storage style.
So for people who are wanting to get into it, you really do need a trusted exchange. That's the safest way.
An exchange is a place that you're going to buy it from.
That's right, where you buy it from, and that's a big part of what we do. So you'll find other exchanges that you can have apps on your phone, and there's a few of them in the country. You probably see them advertised at sporting events and things. That's one way to do it. We tend to cater more for people who want to sit down, understand it. It's more of that education journey, but we can also hold that, and most of our customers, we hold it for them. Yeah. But then if you've got someone holding your asset, it's got to be a trust-based relationship.
So essentially you've turned it into this relationship, the same as if I wanted to buy a gold. I've got $100,000, or what's a kilo these days?
More than 100,000. Is it a lot?
I'd walk in with, $100,000 in my bank or cash or whatever. I'd come see the Ainslie Group. I'd buy my bar of gold. I'd be like, oh, this is one, heavy, and two, this is a lot of responsibility. Can you store it? And you've got the reserve vault.
That's right. So
storage boxes and stuff. You've basically replicated that.
Exactly, because we know that ultimately what builds long-term customers for us is people who want the asset, and lots of people want the asset and buy it and take it with them. That's fine, right? Like that's what we do with gold and silver, and as you pointed out, that's what we can replicate.
So you can walk out the door with
crypto.
Your bar
you can
of
walk
gold,
out, and you can walk out with the
door.
crypto, right? But really, the core of our business is probably people who go, I don't quite understand all of that, or I don't know where I'm going to put $100,000 worth of gold in my house safely. So
especially if it's
they
silver.
want a partner. Well, it's silver that's very bulky and heavy.
Yeah.
Although $100,000 doesn't buy quite as much silver as it used to, so it's less bulky and less heavy. But that's probably a big part of what we do is work with people to hold it for them. Yeah. Right. Like to figure out what storage solution suits them, whether we're holding it, whether they're opening a box down at like you said, the Reserve Vault in Brisbane, or the Melbourne Vault in Melbourne, or where they want to store it, what makes sense. So that's probably the how bit, and the bit that most people find tricky. We, similar to what you're doing, put out a lot of educational information. So they can visit all of our sites linked through ainslie.com.au, so they can go and have a bit of a look there and see the different products and how that works. But I think the guardrails bit is the most important for me. If you're coming in and you're new, the trick is to just have some exposure, like buy some, play around, but do it at a scale that's safe for you, and do that with a partner that feels safe to you. Yeah. And I think from an investment thesis, like there's probably more an argument to be made. There's more risk in not having any. I term it asymmetric risk, saying that the risk is always to the upside there, because if I'm right, you make a fortune. If I'm wrong, you lose a little bit. Where do you get that opportunity? If you make that fortune, the risk then becomes how you manage it. That's what we're talking about now, that the risk is not so much the performance and the outcome and that. Do your own research on it, but then do your research on managing it and storing it and what you're going to do with it. And
that partnership as well. If you do go down the getting someone to store it, whether that's on an app or at the Ainslie Vault, just understand the pros and cons, I guess, of that storage facility.
Yeah, and that's just reinforcing that again. It's not, and we even said this about the property and the investing and all of it. Your only risk is that, well, there's two risks. The risk that you don't do anything is a risk because of that asymmetric sort of upside that I was talking about. But the other risk is that you don't know enough about it, so you end up buying that property that doesn't do anything for whatever. So that's why my answer to that is ignore all the noise around all of the other. There's many other cryptos and things you can buy. I'm only saying here Bitcoin that I can speak with that level of confidence.
100% agree.
Long term, as safe a bet as you're going to get. Still a bet, but a safer bet as you're going to get with that asymmetric risky upside.
Just to really
buy some Bitcoin.
Clarify and echo that point. We're not talking about World Trump financial and liberties and memes and Farcoins and none of that shit. We are shit coins.
Yeah.
We are talking specifically about Bitcoin here. And again, it probably is too far into the weeds, but it's going down that. It's the only one that's completely anonymous and decentralized versus pretty much everything else has some sort of person or
and it just knows what it is. Like all these other tokens can make and have made and will make people lots of money.
Yeah.
Right, because they'll pick the right one, but it's just picking stocks.
But every headline you see where someone made a lot of money,
someone's lost a lot because another
a lot more
project,
people tenfold that have lost a lot more.
The Bitcoin knows what it is. Bitcoin is purely trying to be, or purely is, a new form like gold, right? Like it's a store of wealth. That's it. Nothing else to it.
Yeah.
So as long as people continue to believe that, the same as gold. Like what is gold really, other than people's belief that we need something to store our wealth in?
Yeah.
It's worked for 5,000 years storing it in this lump of metal, so we'll continue to do that. It's the same thing. It knows what it is. So, and that risk is to the upside, like that you've got that asymmetric risk to the upside that it continues to gain traction. It's already gained a lot of traction. It's not going anywhere. So you can have a little bit of exposure to it. Yeah. That's it. But that risk for you personally is that you get your friend, you get whoever that doesn't really also know what they're doing about, and you end up in a scam, or you end up in a situation where you bought on exchange that people worry about, the FTXs of the world, like things that have happened in the past where exchanges just disappeared and people lost their money, lost their Bitcoin.
Like, to me, it just comes back to that comment about the pokies, I guess. Like, you're going to lose money on the pokies. I would say there's a higher probability of losing on a lot of those exotic altcoins, than there is that you're going to make it. So just stick to where something with the proven history, I guess. Property, Bitcoin, But the further down that risk curve you go, the higher the probability that you're going to come into security issues, rug pulls,
all of that.
Non-performance. It's just a cowboy world. The further down that risk curve or altcoin curve you go.
And when you've still got such huge returns possible.
We only have to get onto a compound interest calculator.
That's right.
And traditionally prior to this asset class evolving, like, share markets, 8, 9, 10, 11%, 12 was astronomical, for the traditional financial world. Property sits at about 6.8, 7% or whatever. Cash goals and all that maybe sitting below that, and you can argue inflation adjusted on all these terms and stuff. But, if we're looking at Bitcoin, you've got, potentially as that 24/7 risk on, risk off style asset, as well as the adoption curve you mentioned. So you get a premium, I guess, for the earlier you are, the more premium you earn on it. So we are
still early on that. Yeah. You still have a reasonable expectation of 10x.
Yeah.
Probably more than that in a relatively short period of time, as in like 5 to 10 years. Like if your property is doing 10x in 5 to 10 years, that's as much luck and precision picking as anything. Yeah. Like that's not really a realistic expectation, whereas it could be considered a realistic expectation when you're talking about Bitcoin.
But you don't also need it to 10x. Like if you just Google compound interest calculator, I don't know, ASIC have one out there, so a government calculator, and just plug in learn. Like, so plug in, if I buy a property at 6 or 7% long-term averages, 10, 15, 20 years, what is that going to look like? Then plug it in with, okay, if I've got savings in the bank, I get 4%, maybe 5%, but I get taxed a third of that, so I'm going to put in 3%, and that's what you're going to make. And then put in and play with long-term history of what Bitcoin has done, or potentially, it doesn't need to do 40, 50, 60, 100% a year, and it's not possibly going to anymore.
It needs to do 10%, and you're going to be miles ahead.
Yeah, but what if it does 10 to 15%? Put that in that compound
and realistically, that's what I'm saying.
Yeah.
Realistically, these are not crazy numbers at all. It's actually more probable than not that you're going to get those sort of returns.
Yeah. And this just comes down to that knowledge and understanding and education piece. But Chris, as we wrap up, any final thoughts, points you'd like to finish off with?
No, just I think we've covered a lot. Really, the last point I'd make would be where the price is today. We're not at the all-time highs. We're well down. We're 60% down,
halfway or so,
ish, right? Like you get an asset opportunity. Like if property was down 50%, people would be very surprised because but it's a market. But if property was down 50%, the argument would probably be, well, long term, we haven't solved all these problems. We just have a property, we still have a housing crisis. We still have all these reasons why it needs to go back up. So you go buy. Same with Bitcoin. Historically, whenever it's down like this, is the time to buy. So you're probably listening to this at the best possible time to dip your toe in, because your risk is much lower at the bottom than it is at the top.
Yeah.
So that would be my final sort of nudge to people. If you haven't taken anything sort of, it hasn't really shifted your opinion at all listening to this, just have that in mind that, well, you're also taking a risk not to have some. Yeah. And it's not a bad time to just dip your toe in. So just have a go, see what happens.
I use an analogy, like it's like sports betting. Like I'm a big rugby league fan, soccer, I love my Formula One, so I follow these sports. But if I ever want to learn a new sport and follow it, I find gambling on that sport forces me to pay attention because all of a sudden you're invested.
Yeah.
Right, and I use invested in a loose term. It's probably not the best term there, but do you know what I mean? You pay so much more attention and you start learning about it because you want to say, oh, well, who's going to win? And you want to bet on the right side because you know you're going to make money out of it. If you're trying to learn a new asset class, whether that's real estate, I'd imagine people listening are wanting to buy one home or an investment property or more. So you're getting educated by listening to this. Same thing with this new asset class and Bitcoin. If it is spiking some interest here, getting a little bit of exposure is going to force you to go down that rabbit hole of learning. And if you've made it this far and listened, please leave us a comment. I'd love to hear if you're interested in more of this type that sits just outside of that property sphere that we're so frequently covering. Please leave a comment, leave a review. Chris, where can people find you?
Best way to find me is probably on X, at Tipper Analytics.
Yep, Tipper Analytics. And then the Ainslie Group put some great content on Ainslie Insights.
And you can find all that on YouTube if you search Ainslie, AINSLIE, or ainslie.com.au.
But Tipper Analytics comes up in everywhere these days, so get out there and have a look. Thanks for listening, and until next time, speak soon.